Hi everybody, today I'm going to share with you the largest pure retail play REITs listed in Singapore. They have 13 years of consecutive increasing dividend track record before the COVID-19. And this is none other than Frasers Centrepoint. Before I look at Frasers Centrepoint, let's look at who is the sponsor for Frasers Centrepoint. The sponsor for Frasers Centrepoint is Fraser Property, which actually is a property developer and an MNC company with an asset of more than $39 billion. Okay, from this organization chart, you can see that Fraser Property actually have properties across multiple countries and multiple regions. And under Fraser Property itself, it is a sponsor for 5 REITs, which is the Frasers Centrepoint, Fraser Industrial Thailand REITs, Fraser Logistics and Commercial REITs, Fraser Hospitality REIT, and Golden Venture REITs. Of all these 5 REITs, 3 are listed in Singapore, SGX, and 2 are listed in Thailand. So you can see that actually Frasers Centrepoint sponsor is in the property business and is pretty big in size. So let's look at what are the property actually Frasers Centrepoint have. They are focused on suburban, and they actually have 9 suburban retail malls, okay, around Singapore. Plus they have 1 small office building, it's called the Central Plaza, which is beside Tiong Bahru Plaza, and their total asset is about $6.2 billion. And from this map, you can see that all the retail malls they have are located beside an MRT station. So that means there is, and they are all in a residential area. So the large catchment area for these REITs, which explain why they have done well in the past 13 to 14 years. What I like about their property is it is pretty well diversified, and you can see that not more than one property contribute more than 22% of the portfolio value. The one that commands the biggest value is Causeway Point, which is about 21.6%, followed by the North Point City North Wing. But this only happened after they fully acquired the Asia Retail Fund, which is more than 1 year ago, and thus this will become their current portfolio. But before they do that, this is what they are actually property distribution. Before they actually fully acquire the Asia Retail Fund, they only have 6 shopping malls, and you can see that Causeway Point actually contribute more than half, or close to half of the revenue, followed by North Point City. So you can see 2 shopping malls become the main property that contribute to the REITs itself. Actually, the concentration risk is pretty high. But after they do the acquisition and they do certain divestment by selling off UT Point, Anchor Point, and Bedok Point, and this become their current portfolio, which become more balanced and it become more diversified, and it's scattered around Singapore, and all the shopping malls are connected to MRT stations. And let's look at our past 5-year performance. Okay, let's focus on the DPU. We can see that actually their DPU have been increasing except last year, the COVID-19, where they have a drop. We'll talk about that later. But nothing to think of is you look at that NAV, which is constantly increasing over the past 5 years. Okay, this is a pretty good thing, even despite during the COVID period, their NAV have actually also increased. And one thing to take note is their gearing was on the lower side, and actually their gearing was less than 30% for 3 consecutive years. But after they start to step out the gearing when they start to acquire property, which to me it become healthier, because when the gearing is a bit too low, means actually they did REITs are supposed to leverage to a certain extent. If it's too low, it means that practically I consider them a bit under gear. That means they didn't really maximize their potential. So look at their current financial status with a gearing level of 33.9%, which is pretty decent, and which also means that they got more than $1 billion in headroom if they were to hit 45% gearing. And their interest cover is very healthy, which is 5.2 times, which is much higher, more than double of what MS require of 2.5 times. So to me, that financial status is a very healthy thing. Look at their top 10 tenants. You can see that top 10 tenants only contribute less than 20% of it. Actually, we can see NTUC, okay, we can see Daily Farm, You can see Kopitiam, or even can see the banks, OCBC and UOB, and even McDonald's, Yum. All these are mainly what towards, we call that more towards a defensive play, because this is more of an essential services that everyone need. And thus, in despite of market downturn, all these essentials, we still need to go supermarket to buy things. We still need to maybe go Kopitiam, go food court to eat. So all these are pretty essential things, and they belong to the top 10 tenants of the REITs. We make these REITs more resilient to market downturn. We make this REIT more defensive when there's an economy downturn also. And look at their category, about 1/3 or slightly more than 1/3 is under F&B, which is a good thing when it comes to retail mall, as now most people go to a shopping mall mainly to eat, for gathering purposes, to meet friends, and I feel that the retail is pretty good weightage for the REITs for them to grow. And let's look at this is the DPU. They have a very good track record of 13 years of consecutive DPU growth. Even during the global financial crisis, I can see at FY 2009, despite the market have crashed during that period, their DPU have also increased. So this makes them one of the few REITs in Singapore that have increased their DPU during the global financial crisis. However, during the pandemic last year, their DPU actually have dropped. But this one we have to understand that when the circuit breaker comes, shopping malls are told to close. Okay, and they need to give tenant relief. And of course, this will definitely affect the shopping mall business, because although they are suburban mall, they will be affected. Thus, a DPU drop is expected for this type of REITs. And however, we see that this year, first half, they seem to have recovered quite a fair bit. You can see that the first half DPU is about close to 6 cents. We just assume that second half is the same, and then they will go back to 12 cents. I expect them to be able to recover their DPU, go back to the pre-pandemic level pretty fast compared to some of the REITs in the market. Let's look at the price chart for these REITs. We can see that before the global financial crisis, they have went to a high of $1.91. When the crisis hit, their share price had dropped to 45 cents, which dropped close to 80%. This is pretty normal for almost all the REITs listed in Singapore during the global financial crisis. And REITs drop more than the stocks because of the nature of the REITs itself. However, these REITs have managed to recover back and even go higher than the global financial price, okay, around in 2013, where up to today you can see some of the REITs still have not managed even able to recover back to their all-time high price in 2000 global financial crisis. And in fact, that it even go higher to 307. That's before the COVID-19 start, and after that, then of course it started to crash down, okay, due to the COVID-19. Now let's look at their 2-year price charts. Their current asset value is around $2.31, and the REITs have constantly maintained their price to NAV above 1 before COVID-19. But when COVID-19 comes, their price to NAV actually have dropped way below 1 to $1.55, which is a common thing for all the retail related REITs. However, it managed to recover very fast, go higher than the NAV compared to some of the REITs which are still struggling below their NAV. And because of the on and off, we start to have phase 2 heightened alert, start to go back phase 3, and start to have restriction of movement, dining movement. This indirectly creates some downward pressure on the REITs, and thus the REITs can't really grow up fast, and it starts to hover around their NAV, which actually indirectly provide a very good support price for the REITs. Besides this, we will want to look at another thing, that this REITs, although it is a Singapore focused REITs, it's a Singapore retail mall focused REIT, it itself also have an investment in a Malaysia REITs, which is called the HEKTAR REITs, which happen to be also a retail REITs. And this HEKTAR REITs have 6 shopping malls in West Malaysia, and this HEKTAR REIT is about $1.2 billion ringgit, and the REITs hold about 30% holding on that. And however, this REIT was not really performing well in the past few years. You can see that their dividend has started to drop since 2016 to today. And during this COVID period, some of the quarter they didn't even pay any dividends. It is 0 dividend. Look at the share price have been crashing down since 2017 from around $1.70 to all the way current price about 60 cents. So you can see that these REITs actually don't really perform well. However, we look at the size compared to Frasers Centrepoint. Frasers Centrepoint have about 30% on this $1.2 billion ringgit property, which translated to Sing dollar equivalent is less than 200 million. And Frasers Centrepoint, actually the asset in Singapore is 6.2 billion. Thus, the performance of these REITs, although it's not that well, impact on Frasers Centrepoint is actually negligible. Next, we look at another concern is the occupancy. Currently, the occupancy is about 96.4%, which is pretty decent, especially during this current period. However, we just need to take a look at there is some low occupancy is on the Central Plaza. We happen to be the office building. This contributes about 3.6% and under our asset portfolio to the REITs, and also the Century Square, which also have a very low occupancy rate. But with the pandemic going to over soon, we expect that the occupancy rates will be able to pick up. It may be able to provide small positive catalyst to the REITs. They have bought over this Asia retail portfolio of REITs. It will take time for them to adjust it, to synchronize it with the main portfolio. So once everything is synchronized, I think that it will be better potential. For example, Century Square, they still need to pay tax, pay more than 100,000 of tax every month for Century Square. But after that, they convert into the REITs asset class. This tax will be saved, and in the end, you can save more than $1 million in tax savings, and this tax saving can translate into dividend income to give to investors. So this is what is positive about these REITs currently. Next, we look at recovery. Are we recovering from the pandemic? As we have more, about 80% of people in Singapore already vaccinated. We look at this shopper traffic. As of July, we still about 60%. That means we still have 40% growth to hit the pre-COVID average level. But we look at the tenant sales. As of July, we are 91% before pre-COVID. Actually, the tenant sales is almost going to recover to the pre-COVID level. And coupled with the shopper traffic were to increase, getting better, I think the tenant sales should be even better than pre-COVID level in the months ahead to come, when Singapore starts to reopen more, and we will expect more positive catalysts for these REITs. Let's look at their portfolio overview. As we see that these REITs are all 100% suburban mall, when more than 40% of the net lettable area for these REITs is for essential services. And these essential services contribute more than 50% of the REIT's gross rental income. Essential services are defensive in nature, and thus it will provide a certain level of stability for these REITs if there is a future market downturn going forward. And now look at what are the growth potential for this REIT. We know that Singapore is pretty small, and when we look around, don't really have much sizable shopping mall or even suburban retail mall for Frasers Centrepoint to go and acquire. Okay, so that is one of my key concerns on this REIT. So on their growth future. In the near future, like maybe in the next 3 to 5 years, maybe they will have this growth potential to acquire North Point City South Wing, which is currently 50% owned by the sponsor, which is Fraser Property, and now 50% owned by TCC. Actually, you can say it's a parent company of Fraser Property. So that is a possibility that they can acquire North Point City South Wing in the foreseeable future. And another part is Waterway Point, where they actually only have about 40% stake on Waterway Point. So this also means that they may have a potential of acquiring the balance 60% of Waterway Point in the foreseeable future. However, this one is not really fully owned by the sponsor, so we don't know how will it develop to. However, do think if they were to acquire both properties going forward in future, it will definitely require some equity fundraising, as the value of these two properties combined is more than their current debt headroom of 45% gearing. So this is something you need to take note. So in a nutshell, I personally feel that Frasers Centrepoint actually have a very good track record, and I foresee that their DPU were able to grow and their DPU were able to recover and grow even better. And in the near term future, there is still significant pipeline for them. However, long term, we need to look out of what is the manager direction, on how are they going to further grow these REITs. So this is something we need to think of that when you want to invest Frasers Centrepoint for the long term. That's all I have to share for you today. And if you feel that this video benefit you, do remember to like, share, and also comment below. Lastly, do remember to subscribe and press the bell button so that you'll be notified for the next video. I shall see you in the next video. Bye bye.